Hi everyone, it's Terry Gardner from CJ Lawrence on Wednesday, June 29th, coming to you from Midtown Manhattan. It's been a couple of weeks. I hope everyone's been well. The market has not been, so let's dig in. Let's look under the hood a little bit here and see what's been going on. We've got 4 key points to our call today. First off, we want to summarize the macro environment in which we're operating. 2, we want to introduce the 3S investment strategy for the current environment. 3, discuss how yields come in different varieties. And then 4, we'll sum it all up. So first off, the macro, it hasn't been pretty in the markets and the economy. Just looking at some figures today, the NASDAQ is down about 28.5% on the year. The S&P 500 down 20, the Dow down 15. Of course, these are round numbers. Gold's been flat on the year, interesting. WTI crude up 45% for the year. Crypto, depending on which crypto asset you're looking at, down between 60 and 80%. Even long duration treasury bonds on the price side down 23%. Short duration down 5.25%. So it's really been a tough year to date in most asset classes. It's been very challenging, and there's significant cross currents that we're continuing to face as we think about where we are in the year and what the back half of this year and next year look like. First off, we're still seeing record high inflation, particularly in food and energy. We're wrestling with rising interest rates, continued geopolitical conflict, global supply chain challenges, amongst other issues. And on the corporate side now, we're starting to see how rising input costs are going to impact corporations and corporate profits. So we're seeing companies wrestle with higher costs and lower margins, labor shortages, and continued supply shortages of key raw materials and inputs. The net results is that forecasting has become increasingly difficult from a macro and a micro perspective. And that tends to cause consternation in the marketplaces, right? The market loves visibility, and when you don't have that visibility, the market and the collection of investors tend to take to the sidelines and wait out till the dust settles a little bit. So we're kind of going through that process right now. The 2 big questions that the market is wrestling with and trying to build consensus on, and which are necessary for the market to gain some solid footing, are, what will the sustained rate of inflation be? The Fed looks like they're going to be aggressive in the next couple of meetings to try to raise rates and head off inflation. And if they're successful or unsuccessful, what does the new rate of inflation look like? The market's wrestling with that matter, and I don't think there's consensus there. And additionally, likewise, what does GDP growth look like for the next year, 2, 3? Given the Fed's outlook on interest rates and inflation. So on inflation, we're watching a couple of developments to see how that argument plays out. First off being China. China's been offline, right? So part of the global supply chain challenges that we've been facing have been because China has had its own bout of COVID crisis and has closed down large portions of the country. As we know, and as it's been called, China is the manufacturing shop floor for the world. So when they close, it exacerbates the supply challenges that we have in goods across the whole economic spectrum. So we're watching to see when China comes back online. And China coming back online could be disinflationary as they start to crank out more goods. They've got their own challenges at home. They may try to want to export their way out of those crises. And then, of course, in conjunction with China's reopening, the entire global logistics and supply chain network, which has, for a lack of a better term, been gunked up for the past year, we're starting to see some easing there. We're going to look to see how quickly container ships move in and out of ports, offload goods, and how quickly trucks and railroads are able to get those goods to market. That process is improving. It's not where it needs to be yet, but we're looking to see if that will start to really accelerate the pace of goods and inventory restocking in certain key industries. And then finally, labor and unemployment. Unemployment's been at historic lows. We see in the paper and hear on the news all the time about 2 job openings for every person looking for a job. So it's going to be interesting to see and important to watch whether or not the Fed's activities in raising rates to slow the economy impacts that ratio. Do we start to gain parity whereby where there's 1 job for every worker looking? So those are a couple of things that we think will impact inflation and the outlook for inflation in the coming weeks. And so as the macro kind of puzzle pieces fall into place, we're going to have to then recalibrate our models and expectations for what the remainder of 2022 and 2023 look like. But as a second point, that doesn't necessarily mean that there won't be specific opportunities in the stock market, and there are, and we're finding them. That's why we want to introduce this concept of the 3 S's to investment strategy for the balance of this year and into next. And the 3 S's stand for, first, secular, second, scarcity, and third, subscription. And I'll go into a little bit of detail here. So secular, this is something we've talked about at CJ Lawrence with our clients for years, that what we look for, the qualities we look for are companies that are involved in secular growth, whereby they don't necessarily need an economic cycle to push their products and services forward. They are reinventing or inventing new industries and taking the lead. And we've seen these secular tailwinds impact a lot of the leaders over the past several years. Our view is that these secular tailwinds will continue to blow. And even an economic slowdown won't reverse course or slow down the secular trends taking place in the global economy, including cloud adoption. We've heard about cloud adoption for years, but it's remarkable to know that only about 19 to 20% of the Fortune 500 has actually adopted full cloud infrastructure. So there's still a long way to go in terms of cloud adoption. Secondly, artificial intelligence is really just coming to the forefront in the way consumers select goods and services, in supply chain management, customer behavior, etc. So there's a long way to go there in artificial intelligence. Dovetailing right into digital transformation. Every company certainly domestically in the United States and globally is going some type of digital transformation in the way they provide their goods and services to customers. Energy technology and transition couldn't be more timely given the circumstances we're facing today. Gene-based medicines based on genomic science. These are all secular tailwinds that won't reverse. So we want to own the leaders in those spaces, and we believe they'll continue to be winners. The second S that we mentioned was scarcity. Much more timely, perhaps more short or medium term, but we are facing important scarcities in critical goods and services in the global economy today, particularly around energy and around food scarcity. So we think that that's a very investable theme in the current environment. The third S was subscription, and I want to explain that a little bit, because what I don't mean is your product subscription, perhaps a Netflix subscription or Disney Plus. What I'm referring to are mission critical subscriptions for the enterprise, for business enterprises, whereby there's huge barriers to entry and the service providers are essentially price deliverers, the customers are price takers. These are companies that offer a service offered by few, whereby the payments are on a subscription basis, usually multi-year. So there's good visibility of earnings for investors who in these businesses. And as we've discussed earlier in this video, the market investors like predictability. They like forecastability. They know then how to assign valuations to companies that have a revenue or earning stream that is somewhat forecastable. So subscription businesses at the enterprise level, not necessarily at the product level, but the enterprise level, look very attractive to us in this environment. bring me to my third point, which I think is somewhat unique in that we've been looking at yields of different flavors. And the conventional wisdom is looking at yields in different buckets, whether they be bond yields, dividend yields, earnings or cash flow yields. Buyback yields has become very popular. But I saw an analysis which I thought was quite interesting, which actually combined buybacks and dividends into a combined yield. And so what I think is happening in the market is some of these companies that are not only paying out and rewarding shareholders with cash dividends, but also buying back shares at the same time are becoming increasingly attractive. What was interesting to me in the analysis is that the usual suspects weren't at the top of the list. So when you think about dividends, you often think about energy companies, consumer staples. Interestingly, when you combine them with buybacks, they're towards the bottom of the list. And at the top of the list of combined yields were companies in the communication services sector, which was at the top of the list with a 6.34 combined yield, suggesting that between dividends and buybacks, these companies generate about a 6.34 yield on their at current prices. Who's in communication services? It's the Google, Meta, formerly known as Facebook. The telcos are in that space, as well as some of the gaming companies. So definitely worth a look. Who was in second place from a sector perspective? Technology, another surprise on a combined yield basis, 5.51%. The big giants in that space are Apple and Microsoft, clearly. So in summary, the near and medium term looks to be volatile. There's less visibility than we would like in terms of the macro and the micro outlook, and that probably creates some investors to stay on the sidelines while all this gets fleshed out. But there are good opportunities in the market, as we pointed out with the three S's. And there's a lot of hard work that's already been done. And so the risk-reward ratio to the market is starting to become a bit more favorable. Could there be more downside here? Certainly. Could we see 5 or 10% downside? That's plausible. But what I did see was an interesting statistic today, whereby someone calculated over the last 12 recessions, so if we are going through a recessionary period, the average drawdown to the S&P 500 was 30%. Well, I mentioned earlier that the drawdown on the NASDAQ is 29.5%. So it's already at the average of what a recession would generate in a drawdown in the market. So a lot of hard work's already been done. Risk reward is getting a little more favorable, but it's important and finally to be increasingly selective. With that, I'll wrap it up. I hope you take something away from this video. If you've got any questions, give me a ring at 212-888-6403 or reach out to me via email, tgardner@cjlawrence.com. Hope everyone has a great 4th of July. Happy Independence Day.